Alright, the recording is on. So let's get started. Let's go on the white, open up our notes. Let me go ahead and delete that. Alright, so here's how I usually scan for like long-term ideas. When I scan for like long-term trades, swing trades and things like that, there's a very precise framework that you need to follow. Alright, very precise framework you need to follow. So everything is a top-down analysis. Top-down analysis, which basically means I start with the monthly, go to the weekly, go to the daily, right? And then that's basically what I use for swing / core trades. And the way it works is I usually write down like this. So first I build a framework, okay? So actually the bias. So first thing is the bias. The way we form the bias is like this. We type in spider, all right, QQQ, IWM, I look at XLF, I look at XLU, I look at the VXX, UUP, FXY, GLD, SLV, and the Dow, IYT. Alright, so these are all ETFs. Alright guys, these are all ETFs. So the spiders is for the S&P 500. Alright, S&P 500. So those, if you're totally new, you'll see that. This is the NASDAQ ETF, right? And this is for small caps, Russell. XLF financials. XLU utilities, VXX volatility, UUP dollar index, FXY Japanese yen, GLD gold, SLV silver, right? And then the Dow obviously is Dow Jones, and IYT is transports. So why do we look at these? So the reason we look at these is obviously S&P 500 will have bulk of the stocks, right? The energy stocks, everything is in the S&P 500. Qs are mostly going to have tech stocks, biotech stocks, right? IWM Russell will have like small cap stocks, right? Financials are like banks, financials, credit card companies, and utilities will be things like, like your PG, right? Procter and Gamble, all those will be in the utilities. Volatility index, VIX, which is just inverse of the market. The dollar index we look at because the dollar has an inverse relationship to commodities. So the dollar goes higher, then that would mean that the gold, silver, oil, those things are going to go lower, right? And then the Japanese yen also has an inverse relationship with the market, which basically means if the Japanese yen is going higher, then usually the stock market is going lower. If the Japanese yen is going lower, usually means the stock market is going higher, right? And then gold, obviously, silver, pretty self-explanatory. Dow Jones, pretty self-explanatory. 30 stocks, Dow stocks, and transport. So the reason we look at all these things is this. So here's how you build your framework, okay? When the market is going higher, all right, you want to see the same sort of participation from financials, right? You want to see the same sort of move in transports. Actually, you know what? Two more things I missed here, now that I think about it. USO, we're going to look at oil, all right? And there's another thing I wanted to look at. We're going to look at, let's see here. We're going to look at SMH. Semiconductor. So the reason we look at all these things is because when the market's going higher, now for you to confirm that the market does indeed have strength, you want to see the financials lead the market. You want to see the semiconductors lead the market. You want to see transports lead the market. Or if not lead the market, then at least have the same level of participation as the market. So when those things are all going higher and the market's going higher, that is known as a confirmed move, which basically means market is strong and can continue to go higher. Now, if you see like a divergence, like let's say spiders are going higher, but the financials are still weak, or spiders are going higher, but the tech stocks are still weak, the semiconductor is still weak, right? That means that that rally in the market is less. I mean, you have to trust it, much lower than the rally that would have been done with all these participating instruments. Make sense? So just to sum it up, market going higher, you want to see all these things participate with the market or at least lead the market. That is confirmed move. If you get a divergence, like all these things are not participating with the market rally, that basically means that the market rally is less trustworthy. You got to be a little bit cautious and tighter with your stop losses. So in a bullish market, in a confirmed market, I'm more likely to give stocks more room, right? Like I'm going to give them big stop losses and really give them a leeway to move around and jiggle around, and because it's a confirmed move. But if the market has a divergence and other instruments are not participating, that's the time where I'm usually, I guess, a little bit tighter with targets and a little bit tighter with stop losses. And I'm more likely to like take half profits, trail my stops tightly, and all those things. All right. So that's kind of how I use these things. So let's dive in. Let's take a look at some charts, and we'll start writing it down here also. So taking a look at the spiders, S&P 500 ETF. I mean, this is in a pretty clear channel, right? There's no question about it. A very easy pattern. I mean, markets in the channel on the spiders, right? We go up, we go down, we go up, we go down, go up and down, up, down, right? Moving in a channel. Again, goes back up again, pulls back to the 21 year. Now, here's what's interesting. See how in like April till about like August, or April till July, if you really look at it, from April to July, the market's moving in a broad channel, which basically means from the top of the channel to the bottom of the channel, right? All the way from the top all the way to the bottom. Now, since I guess the mid-July and beginning August, the market has actually changed into a narrower channel, which basically means it's not really coming down all the way to the bottom, right? It's not coming down all the way to the bottom. It's holding in the midway. So what that basically tells us is it's formed a narrow channel inside that bigger channel, right? And that's basically at the 21 EMA. So now the market, instead of going all the way up and down, look what it's actually doing. It's holding a narrower channel, right? And that's exactly what happened today. When we look at today, right? Look at where the market gapped down today. Let me remove this channel for now. Market today gapped down, but where did it gap down? Right into the 21 EMA, right into the 21 EMA on a daily chart. And look what happened. Bounced straight back up, right? So now it's holding this narrower channel and moving in this area. So what does this tell us? Well, it sort of looks bullish, right? Basically now we have our zone. If the market gets back above here, right, which is basically 290, right, then basically that signals the market's actually going to continue to go higher and perhaps continue its uptrend like this, right? But if the market breaks, let's say this 285 area, 286 area, right under here, breaks the 285, 286, there's a potential that it could indeed come all the way back down to like 280, which is that broader channel's low. So that's another thing that could happen here on the spiders. But overall, spiders in a bullish uptrend. That's all that matters. So that's what we're going to write down here, right? Long term is bullish. Short term is also bullish. All right. Now let's go to the NASDAQ. QQQ. QQQ also super strong here, and similar to the spiders. I mean, you have this little trend line going on here. See that? Perfect, right? Literally perfect. Look at this trend line. Sells off, bounces, sells off, bounces, sells off, bounces, sells off, bounces. Comes down, bounces yet again. And today, look what happens. Sells off right into the trend line, and boom, bounce right back up. So just to keep it simple, same exact bias. Let's go to the notes. Okay. Now let's go take a look at the Russell. IWM. We look at the IWM, and that's also bullish, right? See that? That's also bullish. IWM actually had a kind of a breakout a couple days ago, right? Facing resistance, facing resistance, facing resistance, facing resistance. Russell breaks out of the resistance, pulls back, right? Gaps down right into that resistance, which now turns into support, and we bounce right back up. So Russell is also bullish. Oh, sorry, my screen share was off. There you go. All right. So you see the Russell here? The Russell broke out right about there, IWM. This was your resistance levels. Broke out of the resistance level. Today, look what happens. Pulls back right into that resistance level that now acts as support, and we move right back up from there. All right, so it's a breakout pullback. So IWM is also bullish. So that's a good sign. And I'll go over why right now. Let me first write it in here. Oh, my bad. This was bullish. All right. So now, why is it important? Anybody? Does anybody know why it's important for the Russell, the small caps to go higher? Anybody want to take a little guess here? The swing trading you look for 1 to 5 days overnight or long-term holding. It depends. Every trade is different. Like when I get into a swing trade, I don't have a time frame in mind really, right? Like I don't have a time frame in mind, meaning I don't say, oh, this trade's going to be a 1 to 5 day hold, or this one's going to be a few weeks. What I'm basically doing is once I get into a swing trade, I just play the pattern and I keep trailing my stops based on the pivots and whatnot. So regardless of where, how much time it takes, I'll hold on to it. So, but a good way to think about it is if you're trading on a daily chart, the trade's going to last you a few days to a few weeks, right? If you trade on a weekly chart, it's going to last you a few weeks to a few months. If you trade on a 60-minute chart, it's going to last you a few hours to a few days. So that's how you got to think about it, right? Based on which time frame you found that pattern on, okay? Yeah, it could be 1 year. It could be 3 years too. Depends on which chart you're looking at, right? On a monthly chart, the trade is going to last you a few months to a few years, right? On a weekly chart, it's going to last you a few weeks to a few months. On a daily chart, it's going to last you a few days to a few weeks. And on a 60-minute chart, it's going to last you a few hours to a few days. Okay? So that's kind of how you determine that. So nobody has the answer to why it's important for the Russell to go higher. Really? All right. I'll go over it right now. So the reason it's important for the Russell or the IWM to go higher with the market, participate with the market. Yeah, exactly. Janny's got it. There you go. Janny, you got the answer. What is everybody else doing? Sleeping? Only Janny had the answer. Yeah, because that basically tells you that there is a risk appetite right now in the market, right? That means people are actually willing to risk money. That people are, looking for investments. That's what it means, right? Basically what it means is when people are putting money in small caps, that means they have a bigger risk appetite. They're more willing to spend money. They're more willing to invest their money. They're more willing to take risk. So what does that mean? What that means is if they're willing to do all those things, means that they are doing well, right? Means that they have disposable income, means that they have investable income, means that they're doing well, means that the economy is doing well. So that's what it basically means. So when the small caps are also going higher and the market's going higher, that means people have money to invest, right? People have money to invest. So there's more money coming into the market. So that's a good sign. Now, if the market was going higher, but the small caps were not, small caps were dying, that would mean that there's less risk appetite in the market. People are less willing to invest. People are now very cautious. They're not, they're very risk averse. They don't want to invest anymore. They don't trust the market. They don't trust the economy. It could also mean they're not doing that well. They don't have a disposable income, investable income. So that's what it signals. So that's why it's important to see the Russell going higher along with the market. All right. So Russell is also bullish in this case. Now let's take a look at XLF, the financial ETF. XLF financial ETF. So this is very interesting right now. Look at the financials, guys. So the spiders are making kind of new highs, right? Qs are making new highs. Look at the financials. The financials have actually topped out the beginning of 2018, right? Beginning of 2018, the market, the financial, sorry, screen share, there you go, my bad. So see how the financials are totally different, right? The spiders are, at or near the new highs. Qs are at or near the new highs. When you look at the financials are actually not at or near their new highs. They actually have been going down all throughout 2018, right? A little comeback right now, but still hanging around the lows. So the financials have actually topped out beginning of 2018. So if you really look at it, it's actually a downtrend in the financials. Now let's take a look at the higher time frame, the weekly on the financials. The weekly is still sort of bullish. So here's what I would say on the financials is this. Long term is bullish. Short term, however, it's bearish and has relative weakness. Right? Markets going highs, financials are not. So that's not really a good sign. And the reason it's not a good sign is pretty simple. I mean, if the economy, if the people are, if the financials are not participating, if the financials are not doing well, I mean, if the banks of any country, right, the biggest indicator of any country's economy are how well its financial institutions are doing, how well its banks are doing, how well its lending institutions are doing, right? That's the strength of an economy. Now, the financials are not participating, what does that say about the economy? I mean, that maybe they're not doing well, right? Maybe they're not making as much as, they could have. So that means there's relative weakness in that. So that's not a good sign for the market. So just to keep that in note. And the reason I'm going over this right now is because at the end, when we're done with it, we're going to give the market a score, right? So we're looking at 1, 2, 3, 4, 5. Actually, we're looking at 1, 2, 3, 4, 5. We're looking at 6, 7, 8, and 9. We're looking at about 9, 10 things, right? And for you to have a bias on the long side, you need at least 7 points, okay? To have a long-term bias for long trades, you need at least 6 to 7 points. If anything under 6 to 7 points, that's usually a market where I'm kind of like, well, I'm going to be sitting on the sidelines and be cautious. All right. So the next, XLU, utilities. Now, utilities are actually a little bit different in terms of, like, we want to see financials going up, or we want to see small caps going up. However, for utilities, it's actually a little bit different, right? Which basically means if the utility is strong, what that actually tells me is that even though the market's going higher, there is sort of a flight to safety. So utility is considered a safer investment, right? Things like Procter & Gamble, things like, your other famous companies, right? They are utility stocks. And utilities are usually considered safer investments because utility stocks mostly they pay like a dividend, right? Utility stock pay dividends, they don't move enough, they don't have enough beta, so they're very safe stocks. They're considered safe investments. So when the utilities are going higher, that's actually considered a flight to safety, which means people might be pulling out of other industries and putting their money in utilities, and that does signal that maybe they don't trust it as much. However, when we look at it, it's actually sort of neutral. Because when I look at it this way, I'm like, oh, utility is going higher. But when I really zoom out, it's sort of like the financials. The utilities took a hit. And here's what I want you to notice. Check this out. Hold on. Let me try and get the spiders chart here. So I got to unlink those charts, right? Like a symbol. All right. So now let me put up the spiders here. Because I want you to notice something really cool. Okay, so check this out, guys. Check this out. Sort of an inverse relationship. Check this out. November, all right, November to January 2018. Look what happened. Market's going higher, right? People are taking a lot of risk. Now look at what happened in November to 2018 on the utilities. Utilities are dumping. So while the market was going higher in that same period, utilities were actually going down. What does that tell me? People were getting out of their safe investments, right? People were getting out of their safety nets, their safe investments. They were looking to take some risks, right? And look what happened. Market went up and money came out of the utilities, went into other instruments, causing the market spike, right? And now look what happened. Utilities started to go up in 2018. Look what happened. Market took a hit, right? So when market takes a hit, what happens? People start putting money into safer investments. See that? So they take their money out of the market and they put it into safer vehicles, you know, like blue chip stocks, Procter & Gamble, you know, things like Colgate, Palmolive, like things like that. They start putting their money in there. So see how there's an inverse relationship here, guys? So when market's selling up, people start parking their money in safer stuff. When the market starts going up, they take their money out of the safer investments, put in riskier stuff, and that's what happens here. So when I look at the utilities right like this, on a weekly chart, I mean, kind of bullish long term, but short term, that's a tough one actually. This one's a tough. I would say long term neutral, short term bullish is what I would say. But when I look at the monthly chart, I see that it's a beautiful trend line, right? It's actually a very beautiful trend line. It's long term bullish as well. But I would put this in a neutral category, just for my purposes. All right, let's pull this up here. All right. So utility, you would say short-term bullish. Long-term is also in a way bullish. Okay, so that's inverse to the market. So that's not a good thing for the market. Let me type this in red. So long-term bullish utilities, not a great thing for the market. Financials leading it. Financials actually short-term bearish, a relative weakness. So this would be more in the zone of, I would say, like yellow, right? It's not exactly a bad thing, but it's not really a good thing. Oops, hold on. All right, IWMs are leading the market, so that's a good thing. NASDAQ is leading, that's a good thing. Spiders, that's a good thing. All right, now volatility, VXX. So the VXX, I mean, I don't really consider it that much, but all you need to know is that it's an inverse relationship, which means if the market's going lower, the VIX is going higher, right? Market's going higher, the VIX is going lower, and vice versa. So as you saw, the market was basically going higher. Look what happened, VIX was going lower, right? And now the market started to put in a bull flag like this, little pullback, right? VIX is doing a bear flag, so totally opposite. So VIX doesn't really give me any indication right now, to be honest with you. So I'm just gonna say neutral here. Neutral. All right, now let's take a look at the US dollar index, UUP. And the reason we look at the dollar is because the dollar has an inverse relationship to commodities, which means if the dollar is going higher, stuff like gold and silver is going lower. Okay, dollar is going higher, stuff like gold and silver is going lower, and oil too. And the dollar is going lower, then the stuff like oil, silver, and gold are going to go higher. So let's take a look. Let's put them side by side so we can compare. All right, so let's take a look at gold on a daily chart. So check this out, guys. From April, all right, check this out. From April to, let's say, somewhere in the mid-August, look what the dollar did, guys. Look at the dollar. US dollar, straight up. Look at gold from April till August. Straight down. See that? Inverse relationship. Like these are the things you're not really going to learn in any courses, guys, right? These are the things that all the other chat rooms, they won't even know all these things because these are things that, you know, like fund managers and things like that consider. This is called intermarket analysis. So April to August, dollar's on a tear, right? Gold is getting crushed. So there's no surprise. And people say, oh, gold's selling off. Why is this happening? You know, why is gold going down? I'm like, well, the dollar's going up. Simple as that. You know, so that's the inverse relationship. Now look what happened. I mean, look how closely they're related, guys. Oil pulled, the dollar pulled back just a little bit. Look what happened. Gold rallied just a little bit, right? The dollar rallied a little bit. The gold pulled back a little bit. Like, it's so clear, it's unreal. All right. So whenever you're trading commodities, like you're trading a gold stock, you're trading an energy stock, oil stock, right? Trading a silver stock, always make sure you also look at the dollar. All right. That's one thing I will tell you, and vice versa. All right. So now let's take a look at silver. Look at that. Exactly the same thing. If you look at the silver going down, while the dollar's going up. However, the silver looks weaker than the gold. Let's take a look at the weekly time frame here. Yeah, weekly silver bearish. Look at the weekly chart of silver, guys. I mean, the pattern is so clearly drawn. It's crazy, right? Look at the pattern. It's already drawn in on my chart. So you know I've been doing my homework. Look at that. Silver broke out of a wedge pattern. So this is getting pretty bad for silver. All right, let's take a look at gold. Now look at that. Gold also broke out of a wedge pattern, but stronger than silver. Right? Gold also broke out of a wedge, so bearish, but it's still holding the lows while silver is making brand new lows. But longer time, these all are pretty bearish stocks. So I'm gonna put that down here in the notes. Silver, long-term bearish, short-term bearish. Gold, I'm gonna say long-term bearish. Short-term, we could get a bounce, but short-term neutral, I would say. The dollar, long-term bullish, short-term neutral. All right. Now let's take a look at the Japanese yen. And why take a look at the Japanese yen? Well, the Japanese yen also has an inverse relationship with the US stock market, right? I mean, you can pretty much see that right now. Look at it here, right here. Stock market going higher. Look at the Japanese yen going lower. So the Japanese yen, so the reason we look at these things is if the Japanese yen is ready for a bounce, it's ready to pop higher. That would mean you need to be a little bit cautious on the stock market. If the Japanese yen looks, so the Japanese yen has a really bullish pattern, looks really good to go higher. Be cautious on the market long side. That's the way you kind of look at it. So when you look at the Japanese yen weekly, I actually see neutral short term, but maybe a long term bearish because we sort of see this channel here. See that? So we see this Japanese yen on a channel, and that channel sort of broke, right? And you rallied to the top of the channel, now it becomes resistance. So it could go lower, but as long as it's holding this pivot here, it's still an equal low, so it could also bounce back up. So I would say long-term bearish, short-term neutral on the yen. Long-term bearish, short-term neutral. All right. Now let's take a look at the Dow Jones, DIA. Dow Jones. Weaker than the spiders. Weaker than the Qs. I'm going to say neutral on this. It's a long-term bullish, short-term neutral. Now it's time to take a look at the transports, IYT. Now, IYT, let me say that up front, it's not as important as it used to be, okay? Not as important as it used to be. still holds weight, but not as important as it used to be. Why? Because, well, a few years ago, transports was a really good indicator of the country's economy, right? Because we used to have what? Ford Motors, General Motors, right? And if the Ford was doing, we used to have what? Ford Motors, General Motors, right? And if the Ford was doing well, the General Motors was doing well. Like if the transports, the railroads, like if they were doing well, that was considered like a good baseline or a gauge for the economy, right? Because if Ford's doing well, General Motors doing well, then you know that, okay, they're hiring more people, more employment, more jobs equal more disposable income equals more expenditure, more consumer spending, right? More consumer spending equals more consumer confidence. More consumer confidence equals meaning everybody's doing well, so it's a good economy. So that's how transports were important. Now transports are not that important because the country really does not rely on Ford or General Motors, right? The country doesn't rely on that. Now it's a technology-based country. So the queues are a better indicator of that than the transports used to be. But they still hold weight, all right? So on a strong market, you want to see the transports leading or at least going the same way with the market. So that when I look at it this way, the transports are freaking bullish, no doubt about that, but they're not as bullish as perhaps the spiders, because when the decline happened, spiders have since taken out that high. Transports are back up, but they have not taken out that high just yet, right? But it's still bullish though, so and it's going to break it. I know that for sure. But it's relative weakness, so relative weakness. However, long and short term are still bullish. All right, so that's that. Now let's take a look at oil, USO. All right, USO. Man, I'm gonna say neutral on this because it's like it's a very tough pattern right now. Neutral. Let's take a look at our semiconductors, SMH. Semiconductors. Long-term bullish, but short-term neutral, but does have relative weakness to the market. So long-term bullish, short-term relative weakness. All right, so that basically tells me that it's actually a very neutral market right now, right? So every time like I start looking for swing trades, so typically what I just did with you guys right now, this market analysis, typically this is something that you do like twice a month, right? So the analysis that we just did, this is something that you would want to do, let's say, a beginning of the month, right? And maybe middle of the month. So maybe 1st of every month or 31st of every month to like 15th of every month. So you do this twice a month and you formulate your bias. So, and if the bias, let's say everything was going along, right? Let's say the transports were strong, semiconductors were strong, Japanese yen was weak, the utilities were weak, the financials were strong, small cap was strong. Like if all those things were in combination, that would signal that it's a very, very bullish market. So that would signal that you should definitely look for long-term swing trades, right? You should look for long directional swing trades. Now, if all those things were against the market, that would tell me that you got to scan for, short trades, right? So you would scan for some short trades. Now, when you get a neutral bias like this one that we have right now, you see how spiders are bullish, Qs are bullish, small caps are bullish. Great. So now spiders, let's say, gets, let me go to the screen share here. So spiders gets 2 points right now on the bullish side. on the bullish side, but now you see financials are neutral, so it doesn't get those points, right? Utilities are actually bullish, so that's actually bearish for the market, so it actually loses a point now. So now the market has 1 point, okay? Volatility is neutral, so it doesn't get any points for that. Dollar doesn't really impact that. Japanese yen long-term bearish, so it's bullish for the market. So I would say I will give it another point. So market now again has 2 points. All right. Dow Jones, I'll give it another point. So, and transports, I'll give it another point. So market now has 4 points. Right. Semiconductors, I'll still give it another point. So market overall, let's say, has about 4 points. Okay. Now that's not necessarily a market that I want to look for and find brand new long swing trade. That means there's a lot of risk, because relative strength, relative weakness on semiconductors, relative weakness on transports. Dow is short-term neutral, right? Japanese yen is short-term neutral, and utilities are actually bullish, so that's against the market, right? Financials have relative weakness also. So that's not like in a market environment that I really want to find long swing trades in. This is a very neutral market right now, and and you could actually even just tell that by just looking at the spiders in this channel. It's a very neutral channel, and we have our levels here. So here's the levels for me. If you want to play long, the market, I think in my opinion, really needs to get above like 290, right? And actually trigger that buy setup. So then you know you're going higher. But if the market breaks below here, which is 286, market could actually sell off to 280. So that's why we are in a very neutral holding pattern right now, right? Above 290 area bullish, below 286 is bearish. So see how we're in the middle? This is a 50-50 market. 50-50 market, not a good odds market to really look for some stock to hold, right? Because you could very easily pull right back down to the top bottom of the channel. It could as easily break out above that channel. So it's a very neutral market right now to look for any sort of trades, in my opinion. Yeah, so I mean, my opinion right now, my opinion would be to look for trades on the dollar. I think the dollar is going to set up some trades. So dollar, gold, and silver is, I think, what you look for in terms of trading rather than the stocks. All right, so let's dive in. Because see, you guys got to understand one thing. Swing trading is not day trading. Make sense? So I think you already knew that. All right. So on day trading, I'm actually going to whiteboard here so that you guys sort of understand how these things work. Is 2 types of trading. All right. One style is income producing, which means is day trading, right? So we day trade for income, meaning we got to day trade every day, right? So as a day trader, we trade every single day because that's income producing. That's what you're going to use to pay your bills, to live off, right? To cover your living expenses. That's day trading. Now, swing trading or core trading, actually, my bad, this was supposed to be here. So swing trading / core trading is not a form of income producing. It's wealth building. Make sense? So day trading is a form of income producing style. That's what you live off, expenses and things like that. Swing core trading is not to live off. It's not to cover your expenses. It's not your trading income. That's wealth building. So the goal of income producing and day trading is to, what I just said, is to live off, pay expenses, right? Wealth building, your goal is never to do that. Your goal is to build and grow the account. So it's an investment vehicle, right? So this is investment, and this is trading. So when you're wealth building, you do not have to trade every day. You don't even have to trade every week. You don't even have to trade every month. I'll even go as far as to say you don't even have to trade every quarter. Because wealth building is an investment style instrument. Your goal is to make a percentage return on your account, which is at least going to be 2 or 3 times bigger than the market return. So if you invested your money in the spiders or the Qs, you're getting an average of 8 to 9% a year, right? In return. Your goal as a wealth builder is to beat that and get 20, 30, 40% returns in a year. So the model that I already gave you guys, the model that I use for long-term trading, wealth building, all right, is look at BA. I don't want to look at it now. I don't want to look at it. Let's take a look at BA actually. Let's do it. Yeah, back down. Back down, but you never know, man. It could easily bounce right back up here, right? It had a really flash move down, so anything can happen here. All right, so let's go back to the whiteboard. So that's the model for swing trading, and for those who are new, you can write down here model for wealth building. Model for wealth building is to risk again, this is going to be different for everybody. So if you're a brand new trader who just started trading, you're not going to be risking 1 to 2% of your account on a trade. I mean, you're going to be risking like 1/4% or 0.5%. It also depends on your account size. Like if you have millions of dollars, I mean, you're not really going to be risking 2%, right? You're going to probably have a little bit lower risk. So everything is relative, but the model is you risk 1 to 2% of your account on a trade, all right, on any given trade, and your goal for a whole year, so annual goal is 20R. See how different the goals are? Like as a day trader, as an income producing style, your goal is to make 20 to 25 hours every single month, right? Every single month. But as a wealth building style, your goal is to make 20R only the whole year, annual, right? So that basically is what? 20R divided by 12. It's like 1.7, I think. 20 divided by 12. Yeah, 1.6. 1.7 let's call it. So your goal is to make 1.66R average a month. If you can make 1.66 average hours a month, that would mean 20 hours a year, right? Now, if you're risking 2% of your account on any given trade, that's a 40% return. That's a 40% ROI. That's 4 times the average market return. 4x. That's 4 times the average market return, 40% ROI, 1.66 hours a month, 20 hours annually, 1 to 2% risk of your account, you're going to make 40%. Right? If you risk 1% of your account on trade, that's 20% ROI. That's still damn good. So that's the model. Right? How does that work? Well, you do the math. All right? Do the math. You have a $10,000 account, right? What's 2% of that, guys? What's 2% of 10,000? Anybody? 2% of 10,000. Pretty easy math. 2%. 2%. What? It's math, guys. It's not art. You can have different answers. You know? Janny says 2,000. Joe says 200. Ron says 400. I mean, it's not possible. All right? 2%. Yeah. It's 200. All right? 200. So you're risking, your R unit is $200. Right? So if your R unit is $200 and you make average of 1.6 hours a month, that would mean you make 20 hours in a year. Right? So what's 20 times 200? I'll pull up the calculator for you. 20 times 200 is $4,000, right? Is $4,000. So year one, you started with $10,000. Year two, assuming you risk 2% of your account on every trade, your RUN is $200. You make $4,000, right, at the year two. Now look what happens. Look how quickly this compounds. 14K. Now we follow the same model. What's 2% of 14,000? I'm going to do it because you guys are giving me different answers. It's 280. So now on year two, our unit is now $280. Okay, in year two. Now 280 into, again, 20 hours a year. That's 5,600. So what's 5,600 plus 14,000? 19,600, right? So year three is 19,600. So this strategy, by the way, is known as the snowball strategy, because I want to show you how this snowballs, right? Because people might be looking at it and being like, oh, you know, so that's not good. In basically 2 years, I've only made $9,600. That's not even enough to live off. Well, the point is not to live off it anyway. That's exactly what I just talked about. Day trading is income. That's what you're going to use to live off, right? Day trading is income. 20 hours a month is income, right? 20 hours a month is income. Wealth building is not to make money. It's to build and grow the account. That's the only way I was able to open all these businesses at 24 years old. Seriously, because I started trading when I was 18, okay? I started trading when I was 18. And I just kept on compounding it, and then I took that money, bought the real estate. So now if you check out my store, you know, it's a $1.6 million building that I bought, and just because of the power of compounding. Now year four, 19,600 is what your starting balance is now, into 2%. Now our risk now on year four is 392. All right. Yeah, about 392. So 392 into 20, you made 7840 plus 19,600, 27,440. Year four, 27,440 is our balance, right? Year five, 27,440 into 2%. Our risk is now 548 into 20. We made 10,976 plus 27. Now year five, guys. Year six is where the fun starts. This is where things get fun. This is where things start getting really fun, because now the snowball takes effect. 38,416. 8,416 is your balance now. So right now the fun real begins. 38,416 into 2%. Your risk is now 768 into 20. 15,366 plus 38,416. Year six. Balance is 53,782. 53,782. 53,782. Right? 2% of that. 1,075. Right? 1,075 is your risk into 20 plus 53,782. 75,294. Year seven. 78,294, right? So now look at this guy. In first year, all right, you started with $10,000. In 7 years, that $10,000 account is at 78,294, all right, and that is only making 1.6 hours a month, right? 1.6 hours a month, right? I mean, that's like a cheap goal that I had. This is my model. 20 hours my goal on a wealth building style. Maybe you're an active swing trader. Maybe you take a lot of swing trades. Maybe you make 40 hours a month. Now freaking do the math on that, right? But I'm keeping it realistic. 1.6 hours a month. Not even saying anything ridiculous, right? But you could make a lot more than 20 hours a year, all right? You could make 30, 40 hours. Then you start doing the math and you'll go crazy. Now, tell me this, guy. Now, if you had your money, all right, if your money was invested, let's say in a mutual fund, or your money, let's say, was invested in the market, or let's say your money was in your bank, how much would that be, guys, after year 7? Right? Anybody? If you had $10,000 in your bank account, or like anywhere else, how much would that be after like 7 years? Maybe 11,000, right? Maybe 10,000 goes maybe to 11. No, it's not going to be almost the same, because the banks give you half of a 1% or even less as a return. This is 40% a year. The banks are going to give you 0.5% a year. Half. Yeah, so your money is going to be almost where you kept it. 10,000 maybe goes to 10,500. Right? So that's how you use your money. You have to make your money work for you. That's wealth building. That's Warren Buffett strategy. Snowball. Right? And I just want to keep doing it. This is so fun. So let's do it again. This is so fun. Into 2. 0 risk. 20 on your make. Plus 78.5. 294. Year 8. Year 8, guys. 105,411. $105,411 in year 8. In year 8. And you know what the best part about swing trades is? Anybody? What's the best part about swing trades? Anybody? The best part about swing trades is scalability. It's scalability. Right? Day trading, $700 risk, $1,000 risk, that's kind of the limit, right? You start going over that, you're not going to get filled. You're going to get slippage, you're going to get all these things. So $1,000 is kind of the limit as a day trader, right? Swing trader, there is no limit. There is no limit, guys, as a swing trader, because you can get as much as stock as you can have a $5,000 risk as a swing trader, and it won't make a difference, because it doesn't matter. Because when you're looking for dollar moves, it doesn't matter if you get 5-10 cents filled late, right? So you can literally get a ton of shares. Like you can get $2,000, $3,000 risk and not even touch the market. Now here's the best part. Let's say at year 10, now you have a pretty big risk amount. You're like, well, fills are going to be a problem. Well, guess what? As a swing trader, you have the ability to trade options, all right? And in the options market, guys, you can have a freaking $10 million risk unit, right? You can take like thousands of, one contract is 100 shares, guys, right? You can get like 100 contracts and not move a dime on the options market. You can get 1,000 contracts and not move the market, right? That's the beauty, the scalability in swing trades, is you can keep increasing your risk and not be a problem, all right? That's what I want you guys to see. I mean, in just 8 years, we have turned this. Now, this is real trading. This is realistic trading. Maybe it's not for everybody, because some people on the internet, they like listening to how to turn 10,000 into $1 million in 30 days. And what happened? They click on it. They buy whatever the person's trying to sell them. When I tell people this, in 8 years, you can turn 10,000 into 105, even though this is the real shit. People don't find this appealing, right? Because they have like weird kind of imagination. They want to make $1 million like right now. I mean, literally, this person emailed me the other day, Anmol, I've been trading for 3 weeks now and I'm still not making money. That's an actual email. Anmol, I've been trading 3 months now and I'm still not making money. My first question was, did you take PTS? He's like, no. And I'm like, are you in the chat room? He's like, no, I'm not in the chat room. I'm like, okay, so you're not in the chat room, you haven't taken PTS, you haven't learned, so you basically don't know what you're doing, and you've been trading 3 weeks and you want to make profit, like you want to be a profitable trader. Dude, if it was that easy, like, everybody would be doing it. Why would anybody want to become a plumber or electrician when they can just be a trader? It's not that easy. You got to put in the work. You got to learn. So, so this is real stuff. And the reason I do this math with you guys is because I want you to do your math. $10,000 is just an example that I took, right? I want you guys to do the math for yourself, right? And this is what we did in the mentorship. So when we met in the Miami mentorship, I made everybody do the math, which is I said everybody, hey, what's your account size? And we took the actual account sizes, and this is what I want you guys to do. So here's a free lesson for you. Here's a little coaching session for you guys. Is do the math for your own account size so that you have projections, right? Because when you go into a business, when you start a new business, what happens? You need a business plan, right? You need cash flow projections. You need your 5-year plan, financial plan, 5-year projection. As a trader, it's important to have your projections too, so that you have a path to follow. Most people just keep trading. They don't have a path. They don't know where they're going. I have this all mapped out. This is where I want to be year 1, year 2, year 3, year 4. I have it all mapped out, even right now, all the way till 2025. All the way to 2025, I have it mapped out. This is where my account should be at the end of the year, every single year, and that's kind of my goal. I might not get there, but that's the goal that I aspire to, and every year I track it, right? Okay, so this year I should have closed, example, this is hypothetical. Let's say this year I should have closed 2018. I want to close day trading at, like 250K I want to make on day trading. And let's say right now I'm at about 175K, okay? And I keep track of that. This is the goal. This is where I am. How much left? And I write down X amount is left. So let's say, what's left out of this? 250K and 175. Let's do it right now. 250,000, 175,000. So we have about 75,000 remaining. All right. So I'll write down this 75,000 remaining, which I'll now break it down, which means 75 hours remaining. Right? 75 hours remaining. So 75 hours remaining till my end of the year goal. So I have September, October, November, and December. I have 4 months left. So 75 hours divided by 4 months. So I basically now need to make about an average of 19 hours a month, right? I need to make 19 hours a month, and then I can finally touch my day trading goal. So this is how you need to break it down, right? That's why I've been saying to you guys, I want to make 20 hours a month. I want to make 20 hours a month. Why? Because that will get me to my goal. Do you know what your goal is? Most people don't even have goals. So as a swing trading goal, let's say, you'll keep a track of it. Let's say my swing trading goal is I don't know, let's say like 125,000, right? And let's say you're at let's say 57,000. I mean, this year is kind of slow, and you do the math like that, and you see how much is remaining, how much a month do you need to make, how many hours average do you need to make. So now you have a goal to work yourself towards. Because guys, if you don't know where you're going, how are you going to get there, right? If you don't know where you're going, let's say you do get there, how do you know that's the right place? So you need to know where you're going, so you need to plan. So that's what I'm going to leave you with today. I know this was going to be a swing trading scanning session, but the reason I'm not diving into swing trades is a simple reason. It's right here. This is a neutral market, right? Neutral market. It's got 4 points. And as I said earlier, market needs at least 6 points for me to take long swing trades, right? That's that. However, since I am doing a swing trading session here, I'll give you guys any stocks that you might want to throw out before I call it a day. So anybody have any swing trade stocks they want me to take a look at? Anybody have any swing trade stocks they want me to take a look at? And I can take a look at them, and then I'll probably call this a day.